back, Mortgage Musketeers. It's a work in progress. Today we're going to be talking about 9 ways that most lenders don't talk about that you can get into home. Yes, 9 different loan products that are going to help you own the home of your dreams. Check it out. Okay, so the loan products that I'm about ready to list off may or may not be available at your local bank. I am a broker, which means that I'm able to shop around, make your money work best for you. I've got about 9 different lenders that I can look at. They all have different products that they offer to help people get into houses. So it gives me kind of like a lot bigger spread of things that I'm available to do. But you can ask about these, and if you can't, and if you're in one of the states listed below, I can help you out. All right, so what we're looking at is number 1, nationwide high balance. Woo, sweet loan, avoid jumbos. Number 2, home ready and home possible. Number 3, home one. Number 4, flex term loans. Number 5, single premium mortgage insurance. Number 6, split 50 and split 100. Number 7, 203K and Homestyle loans. Ooh, those are good. I'm gonna have to do a whole video on those. And then bank statement loans and assets as income. Now we also have QM loans that are out there, and that's a whole other category that I need to do a video on. But I'm gonna leave that one out for now. I will talk about them later. Now, let's start off with the nationwide high balance. All right. So, what is high balance? First of all, if you live in California or Virginia or Maryland or whatever, you tend to have a higher conforming loan limit than the rest of the nation. It's because the cost of living is so high. So what they do is they kind of raise that, and it's called a high balance. All right, but it's only in those areas. A nationwide high balance will allow you to go above the regular conforming conventional loan limits up to $765,600 across the nation. Hence, nationwide high balance. That way, you don't have to go into a jumbo loan. You get the same rates as you would if it was a regular conforming conventional loan, and you can do 90% loan to value, and there's no mortgage insurance. I mean, it's a fantastic product. A lot of people don't know about it. If you're buying one of those more expensive houses that tend to fall into the jumbo world, as long as your loan amount is below $765,600, I can get you into a home with regular conforming conventional rates, or anybody who can do that, the nationwide high balance. All right, so it's an exciting product. Obviously, I wanted to say yes, I can do it, but any lender who has access to that can take care of it. So definitely ask for it instead of going jumbo. Number 2, home ready and home possible. So when a couple years ago, FHA was just crushing it with loans. You put 3.5% down. It's got a lower down payment. But what was happening is there's a lot of loans that were, a lot of people that were going into FHA loans with high credit scores, and the only reason they were doing it is because they didn't necessarily qualify for the down payment. They didn't have enough down payment. So FHA was taking advantage of that because it's 3.5% down. You know, great rates. You got a high credit score, you're gonna have a fantastic rate. Yeah, they were killing it. So Fannie Mae and Freddie Mac realized, hey, we're losing a lot of business. So what they did is they came up with loan products for 3% down. So when you hear about first-time home buyer products, most of the time this is what people are talking about, because there's no real big, rarely is there a big first-time home buyer. That's something that used to happen all the time. Now, yes, we still talk about first-time home buyers, but normally we're putting them into a program that deals with 3% or FHA, which is 3.5% down. A lot of them end up going with that. Now, the key that you have to know about Home Possible and Home Ready, one is Home Possible is the Freddie Mac version, Home Ready is the Fannie Mae version, same kind of loan product. The thing that you have to know about that is it has an income cap. So you can only make enough, or you cannot exceed that income cap in the zip code that you're going to buy the home, and you have to look it up. The loan officer has to look it up because it's 80% of the median income in the area median income. So you got to look at it, and a lot of people make more, so they don't necessarily qualify for that. A year or two ago, they had exceptions. They had zip codes where they were trying to promote people buying homes in there, and they had no income limit. And that was amazing because people get into a great loan, tend to get lower rates and lower mortgage insurance with those loans. So I would check into that. Just understand that there is an income cap. So if you make too much money, you won't qualify. So you have to see where you're at and actually look that up for sure. There is a 3% down product, which is the third one that we're going to talk about, which is Home One. Home One is a product that is 3% down. The interest rate will probably be a little bit higher, and so will the mortgage insurance, because it's regular mortgage insurance. And if you're sitting at a 3% down payment, the bank owns 97% of that. They have a lot of risk, therefore mortgage insurance is probably going to be a little bit higher. So just understand that. But if you're struggling and trying to get into a conventional product, it might be for you. You got to take a look at the numbers and see what actually makes sense, because your loan officer should be thinking or talking to you about, how do we make your money work best for you? That should be the mantra. Okay, how do we, and we give you choices, right? So I'll give you different loan products and say, hey, this is what you can do, and then I'll leave it up to you as to you and your family as to what makes the most sense. Okay, then there are flex term loans. So flex term loans, you can get into home with all kinds of different terms. You know, you don't have to necessarily go into a 30 or a 20 or a 15. You can go into a 29, a 28, a 27-year loan. You can structure any way that you want, all the way down to typically about 8 years. So there's all kinds of different ways that you can do that, and you can actually figure out how long it'll take you to pay off your loan. If you were to actually calculate how much extra you put down, and I did a video on that, I'll link it up here. All right. But if you don't want to do that, and you want to actually just have a fixed amortized rate at a lower term, there are flex term loans out there. Right, after that we go into single premium MI. Single premium mortgage insurance allows you to basically buy out your mortgage insurance. Instead of having to pay a monthly MI, you can actually buy it out. And there are certain circumstances, and you need to check with the loan product and your lender to see if you can actually have the sellers help pay for that with closing costs and prepaids. So kind of depends on what you're working with there, but definitely something to look into. That way your monthly payment doesn't have your mortgage insurance in it. Now where that comes in handy is if you have some assets, but your debt to income ratio is too high. If we can eliminate your mortgage insurance, we can get your debt to income ratio where it needs to be, and you can get into a conventional loan with no mortgage insurance just by kind of buying it out a little bit. All right, so something to check into. All right, then you also have, along those lines, you have a split 50 and a split 100. And what that does is it's kind of a hybrid. Very similar to an FHA loan, where with an FHA loan you're paying 1.75% up front, and therefore you have reduced mortgage insurance at 0.85% a month. Well, split 50 and split 100 are very similar. You're going to finance some of that into typically the rate, so it's a little bit higher interest rate, but your mortgage insurance is going to be lower. Got to run the numbers to see if that makes sense. All right, and then we've got 203K and Homestyle loans. Your 203K is what you hear about all the time. So 203K is nothing more than an FHA loan with a renovation component. So a regular FHA loan is a 203B, but you never hear it called a 203B. You just hear it called FHA. A 203K is an FHA loan product with a construction component to it, renovation. And then a Homestyle loan is the same exact thing, but for a conventional loan. So if you've ever seen Property Brothers or anything like that, that's all it is you get a bid, and then you can actually wrap that stuff, the renovations or home improvements or whatever you need into the home. And it's a great way to actually deal with foreclosures and some other issues. I need to do a whole video on that one because there's a lot to that, but it is a really good product. The hardest part about that is a contractor. Okay, again, I'll do a full video on that, but just understand it's available to you. And then bank statement loans. So for those folks that have issues with their self-employed and they don't necessarily claim as much on their income taxes, you can use a bank statement loan, and that's where they're actually going to look at your bank statements and see how much income that you actually have coming in, and they're going to figure out what your income is off of that and not off of your tax returns. And that's very, very big for all those folks that have a really good CPA and itemize a million things and make it look like you only make like $20,000 on paper. So definitely something to look into and ask your loan officer about. And assets as income. So as people get older and retire, and they have a lot of their income wrapped up in their assets, they've done a good job saving, you can figure out how that will extrapolate into a monthly payment. and that will give income in order to purchase a home. So yet another thing you really got to kind of dive into it, and there's a formula for it, and you got to look into it. But it is definitely something that you can do in order to get into a home. And then that bonus, that number 10 that I was telling you about, NonQM Loans. NonQM loans are a very powerful loan product for those that don't fit into the regular conforming boxes. And they are designed for people who are self-employed and don't claim all their income if they have assets, if they have money, but they don't necessarily fit into all the other guidelines for Freddie Mac and Fannie Mae. So those people that had a bankruptcy, those people that have a lower credit score, there's just all kinds of loans that you can get into that are non-QM. But the key is, and the very first step is, we have to be able to prove 12 months of on-time rent payment. And for all of those people out there who are paying their rent with cash, watch this video. Stop paying your rent with cash. Stop. Pay with the check. On time, every month, 12 months. If you can show 12 months of on-time canceled checks, you can probably buy a home. But people just don't understand that. Share this with everybody that you know, and then watch that video that I put up there, because it will tell you exactly what you need to do to buy a home if you don't fit all the other rules for normal loans. So I'll stop that rant. I can keep on going. Just understand, a non-QM loan, 12 months of on-time rent payment, housing payment, and you got to have some assets. You got to have some money set aside, because it's probably going to involve points, right? Interest rate might be a little bit higher, but it'll get you into a home. All right, so didn't think I was going to talk that much about that, but I did. There's your bonus. There's number 10. And remember, it's all for one and one for all. Please subscribe. Please help me build my base. Share it with everybody that you know. I need to increase my subscriber count, please. Help me out. So I will catch you later. Hit that like so it hits the algorithm. And I will see you next time.